So in this video, we're going to look at the cash flow statement, which is the third statement in the set of reports that come at the end of an accounting cycle. The other two statements are a balance sheet and a net earnings or net income statement. So this is the cash flow statement. And what the cash flow statement tries to do is to help us decide where we are using or getting cash. And it reconciles something about the ending cash balance in the balance sheet. So first of all, the statement is divided into three sections. The first is cash provided by operations. So this is cash that comes from the assets. This is all the cash that's thrown off by the income of the factory or the sales force or whatever. This particular cash flow statement is for Nike. So you can see that Nike's operations are manufacturing and retail, and so this portion will tell how much money is being provided from the operations. The second section is a section that looks at cash used or provided by investing activities. So that idea is that if you buy a new asset, like a new factory or a new set of machines, you're going to be using some of the money that came from operations to spend on long-term investments. So that's the second section. And the third section is cash used by financing activities or provided by finance activities. So this is things like if we got new long-term debt, that will be an inflow of cash. If we issued stock, that will be an inflow of cash. If we paid dividends to our owners, that will be an outflow of cash. So those are the three sections. So we're going to look at this and look at where some of the key items are and what they kind of mean. So the first one is I've put on here, overlaid on here, the 2013-2014 asset statement, the balance sheet, and I've just sort of cut out the asset part. What I want to look at is this change in cash. So we can see in 2013 the cash was, I think that's probably, it's in millions, so that is $3,337,000,000 in 2013. And in 2014 it dropped to $2,220,000,000. And what we want to know is, how did it drop? So we want to reconcile that difference, the $1.7 billion difference, and you can see that in the cash flow statement, that is the item that we're kind of trying to match. Oops. That is the item here that we're trying to match. We're trying to get the 117,000. So it started. You can see here the cash that comes at the beginning of the year, that's that number, and the cash at the end of the year is that number. This change is the thing we're trying to reconcile in the cash account. What did we use that money on? So we're going to look a little bit more at some of the detail associated with Nike so we can kind of understand this cash flow statement. So the first thing is that we start with operations in the first section, and we're going to, the first line item is net income. So this is the amount that we've already calculated, the income we've already calculated from the income of the company on the income statement. So that number is up there. And so this is a copy of the consolidated statement of income for Nike, and you can see those numbers match. And the next thing in this section is what we do is we say we had this income, but we had a lot of non-cash items. So what that means is that we're interested in cash flow. So anything in the income statement that had to do with non-cash sort of entries that didn't affect cash, we want to add back. One of the main ones we do is depreciation. So if you remember, depreciation is a deduction to recognize that assets are wearing out. So we want to add that back to net income to get closer to the cash portion of net income. And there's some other ones in there that are kind of big for Nike, but they don't usually occur. The only thing that usually occurs is the depreciation item. The next item is looking at change in working capital. And in our cash flow statements, we're going to group all these together, but this is actually a good look at changes in some of the working capital components, particularly accounts receivable. Did it go up and down? In this case, it went up. Accounts receivable went up. So that means that more money is tied up in accounts receivable, so it's a negative to cash flow. Inventories also went up. We invested money in our inventory, so that was a negative to cash flow. And then the other thing, sort of on accounts payable, that last item there, that had an increase in accounts payable, which is a positive to cash flow. So that means that more people owed us money. So that meant that was a positive to cash flow. And then that gets to the total number, which is $3 billion cash from operations. So we had the net income, the non-cash items, and then all the working capital numbers. Now we look at the investing activities. Now these are pretty complex investing activities. The usual thing that we're going to see here is when we say additions to property, plant, and equipment. So this is places where we bought machinery, we bought factories, we bought stuff. So this is a negative to cash flow. We took some of that $3 billion and we invested about 880 million, or Nike invested in 880 million in long-term assets. Nike also is doing some kind of interesting things with their short-term investments. I am not sure what this is. I don't know why they're having so much of an inflow and outflow, but it's kind of equal, so that total number is not really, well, I don't really know what they're doing. They're doing short-term and long-term investments. Short-term investments. But we mostly will just have the increase in long-term assets. So the next section, the last section, is increase in financing activities. So this looks at, do we have long-term debt or do we have equity changes? So in this case, we can see here that there's a long-term debt payment, which is the amount we paid for long-term debt. We made a payment on the principal, so we used some of the $3 billion to pay back debt. The other thing that shows up here is we actually sold stock. So we issued more stock, which is an inflow to cash, so we show that as a positive number. Another thing is we actually Nike repurchased a bunch of stock. So they took $2.6 billion. They went into the stock market and they bought their stock back. That's a lot. That was a definite big decision of the company that usually doesn't happen. They used a lot of their cash to repurchase common stock. They also paid dividends. So for the current stockholders, common and preferred stockholders, they paid out 10 cents a quarter or something like that per share, and that was an outflow. So they had $2.9 billion outflow. So they have the $3 billion inflow, 1.2 outflow in investments, and 1.9 outflow in financing activities. So those together came up with 1.1 billion outflow. And so that's how we look at the cash flow statement.